Hello. In our quest to review for the first exam, here's a good problem on what I like to call CSI Accounting because it tests whether you understand what's going on in the accounts. And so we have inventory, which is a current asset account, which we know are increased by debits, decreased by credits. And we have accounts payable information, which is a current liability, which is increased by credits, decreased by debits. So we would expect to see a beginning and ending balance for inventory on the asset side, and we would expect to see a beginning and ending balance for accounts payable on the credit side. Notice that they tell me that merchandise inventory began the year at $300,000 and ended the year at $250,000. Accounts payable began the year at $15,000 and ended the year at $17,000. Now, what makes these accounts go up and down? Well, inventory increases when I buy inventory. And let's assume here that it's on account. And when I buy inventory on account, the inventory account goes up, as does the accounts payable. So if I buy inventory on account, that's when I debit inventory and credit accounts payable. So this amount is when I acquire inventory and say, oh, let's use my credit card. Now, inventory decreases when you sell your inventory, and it decreases by the cost of the goods that are sold. So we know that inventory is reduced and it goes into an account called cost of goods sold. And notice here it says that cost of goods sold for the year was $425,000. Now the only thing that makes accounts payable goes down is when your bills are paid. So we don't know how much we paid. In fact, that's the question. How much did you pay to suppliers for merchandise inventory this year? So what we're going to do is reverse signs. So ending inventory plus cost of goods sold minus $300,000 beginning inventory will give you the amount of inventory you bought on account, and that happens to be $375,000. So if you bought $375,000 on account plus the beginning accounts payable of $15,000 less the ending accounts payable balance, the difference is how much cash you paid. And so if I did my math right, it's $373,000 was the amount of cash paid to the suppliers for inventory. So notice I had to understand the interplay between the inventory account and the accounts payable account in order to deduce how much cash was paid to the suppliers. And the answer is C, $373,000.